All right, so we've talked about the problems in commercial real estate often on this show, and of course this recession hasn't helped tourism much either. But in the hotel industry, it's the high end that is doing worse than the rest. Luxury hotels in the U.S. are at a risk of default as rooms remain vacant and refinancing remains a real problem. Credit rating company RealPoint says $24.5 billion in loans secured by more than 1,500 hotels are at risk of default. And RealPoint Managing Director Frank Innaurato is here to talk about that with us. Frank, thanks for joining us. Let me first ask you about how close to default we're talking. I mean, could we see hotel chains be forced to close down this year?
Well, there's varying degrees of the level of default risk. I mean, earlier this year we saw on the limited service side, you saw some of the initial signs of stress. Where most of our concern is today is because we've seen such high levels of decline across revenue per available room, average daily rate, and occupancy across the luxury segment, which has led to a lot of the near-term concerns, especially because the size of the loans on these properties within CMBS transactions are very high and can lead to heightened default risk.
Who's in the most danger?
Yeah, it's important to note, though, too, that you have a double-edged sword here. You have a cutback in business travel commingled with a cutback in just leisure travel. I mean, the consumer themselves are pulling back on spending money. As much as they'd love to take a vacation, you know, the mom and pops of the world, they have to take care of bigger issues, so their travel is cut back. But many of the properties that we're seeing within CMBS that are struggling by way of cash flow are because they've had to cut rates to maintain levels of occupancy, and what is that has then led to properties struggling with their cash flow to meet their debt service requirements. But it's important to note not every one of these loans may default, because I've actually had conversations with some of the larger operators and some of the borrowers who remain committed, but they're hitting the flags for default risk.
Well, isn't it difficult, Frank, especially because of the products that these mortgages have been structured into, for them to be reworked or for the loans to be reworked? Isn't that a difficulty?
Yes, it's one of the problems. I mean, within the CMBS REMIC structure, there's typical servicing standards that need to be met. These loans, which were originated during the peak of the market, took on high levels of loan amounts, high levels of debt, and at the time were expected to perform, in some cases, at what we consider pro forma underwritten levels. And what's happening in today's market is they're just not simply generating enough cash flow to meet those levels. Many of the borrowers, some of the loans that were highlighted in the story today, have already reached out to the lender, reached out to the master servicers, so to speak, within CMBS and said, I need some help. But it's not as easy as going down to the bank and saying, hey, we have a relationship, can you just rework my mortgage? Within CMBS, there are standards that need to be followed. There are third-party investors whose value and long-term investment needs to be protected. So you have a lot of different players now coming into the scope here, worrying about these large luxury hotel properties that are either showing signs of distress. The solution is a little bit mixed. I mean, I think what you're going to see over the next 12 to 24 months is a lot of creative workouts by way of these asset managers. Some of the loans where borrowers are willing to stay committed to their properties, maintain the loans being current, you may see creative restructuring by way of forbearance. You may see, in some cases, properties might need to change hands. If certain hotels are no longer part of a company's core business and practice going forward, they may need to be sold to a third party. Okay. And it's also interesting to see, I mean, some of the things that are now going on by way of the government and by way of just regulations, they're trying to change things.
All right. Hey, Frank, thanks for joining us. Frank Innaurato there from RealPoint.